Consumer spending has remained strong, even as overall household debt levels.
Personal loans have truly become the middle-class refinancing option for high-interest credit card debt.
Consumers who have no slack often can't afford to pay their credit card bill.
Americans have more debt than at any point in history. So how did we get here? This is Fiscal Forge. America is one of the richest countries in history. It has some of the world's largest companies, the deepest capital markets, the highest levels of innovation, and yet, Americans owe more money than ever before. Every year, household debt reaches new records. Mortgages, credit cards, auto loans, student loans, personal loans. The numbers continue growing, and while debt itself isn't necessarily bad, the speed at which it has expanded is raising serious questions. Why are millions of people borrowing more than ever before? Is it simply irresponsible spending, or something much bigger happening beneath the surface? Because when we follow the data, a fascinating story emerges. A story about rising costs, changing lifestyles, economic incentives, and a financial system increasingly dependent on borrowing. The answer may explain why so many households feel financially stressed despite earning more money than previous generations. For much of history, debt was viewed cautiously. People borrowed primarily for emergencies, businesses, or major life purchases. But over the past several decades, something changed. Debt became normalized. Credit cards became common. Auto financing expanded. Mortgages became larger. Student loans became widespread. Borrowing transformed from an occasional financial tool into a permanent feature of everyday life. At first, the shift seemed positive. More people could buy homes. More people could attend college. More consumers gained access to products and services. But normalization created a subtle psychological change. Borrowing stopped feeling exceptional. It started feeling routine. And when borrowing becomes routine, debt can accumulate much faster than people realize, especially when new forms of credit continue appearing. The result is a society where debt isn't merely used occasionally, it's often built directly into the way people live.
Consumer spending has remained strong, even as overall household debt levels have risen. U.S. credit card balances reached a record $1.28 trillion at the end of 2025. That's according to the New York Fed. Yet a new analysis predicts that credit cards won't be the main driver of new debt for borrowers this year. And Sharon Epperson joins us now to explain why. And I already talked to you about this. And with just a couple of gals getting some makeup when we were doing that.
Exactly.
And we talked all about it.
It's a big issue. It's a big issue because there's new data released today by TransUnion, one of the three major credit reporting agencies, that's forecasting personal loans will be the primary driver of consumer credit growth in 2026. With loan originations increasing by 5.7%, outpacing the growth in the number of new mortgages through refinancing or purchasing and credit cards. It's the continuation of a trend that started last year. According to TransUnion, unsecured personal loan originations reached a record 7.2 million in the third quarter of 2025, the second consecutive quarter of new highs.
Many people assume rising debt comes from excessive spending. Sometimes that's true, but the data tells a more complicated story. The cost of living has risen dramatically across many essential categories: housing, healthcare, education, insurance, transportation, childcare. These aren't luxury expenses, they're necessities. And in many cases, costs have increased faster than incomes. As a result, households face a difficult reality. Even when salaries rise, purchasing power often feels weaker. More income gets consumed by essential expenses. Less remains for savings. And when unexpected expenses occur, borrowing often fills the gap. This is one reason debt continues growing. For many families, borrowing isn't financing luxury. It's financing affordability. And that's a very different type of debt problem. While household debt takes many forms, four categories dominate the financial lives of most Americans: housing debt, credit card debt, auto loans, and student loans. Mortgages remain the largest category by far. For many families, homeownership represents both wealth creation and financial pressure. Then comes credit card debt. Unlike mortgages, credit card debt often carries significantly higher interest rates. Balances that appear manageable can become expensive over time. Auto loans have also grown substantially. Vehicles have become more expensive, and loan terms have become longer. Meanwhile, student loans continue affecting millions of borrowers years after graduation. Individually, each category presents challenges. Combined, they create a financial environment where many households are servicing multiple debts simultaneously. And that's where financial pressure begins to compound.
Jim Triggs runs one of the largest nonprofit credit counseling organizations in the country. He says subprime borrowers, consumers with low credit scores, generally under 600, are fueling the growth. TransUnion predicts those riskier borrowers will account for 40% of personal loan originations this year, widening the K-shaped split between higher income and middle and lower income consumers.
On the other side of the K on the bottom, there are people who are struggling, and that we're seeing a larger distribution of subprime consumers every quarter, and so they don't have any slack.
Here's one of the most surprising parts of the story. Many households today earn more money than previous generations, yet many also feel less financially secure. Why? Because income alone doesn't determine financial comfort. What matters is what's left after expenses. When housing consumes more income, when healthcare costs rise, when insurance premiums increase, and when debt payments accumulate, higher salaries don't necessarily translate into greater financial freedom. This creates what economists often call financial compression. People earn more, but they keep less. And when disposable income shrinks, debt becomes an increasingly attractive solution. Not because people want to borrow, but because borrowing temporarily solves cash flow problems. At least in the short term, debt becomes dangerous when it starts replacing savings. When emergencies require borrowing, when everyday expenses require credit, when future income becomes committed before it's earned. At that point, financial flexibility begins disappearing. Unexpected expenses become crises. Job losses become emergencies. Interest payments begin competing with wealth-building goals. The true cost of debt isn't always the monthly payment. It's the opportunities lost, the savings not accumulated, the investments not made, the financial resilience never built. And because these consequences develop slowly, many people don't notice them until years later.
Consumers who have no slack often can't afford to pay their credit card bills. So they take out a personal loan to pay off that debt and then wind up racking up more. In 6 months, Triggs says about 40% of borrowers end up having to take out another loan.
At this point, because it harkens back. And then I just thought about what a vicious cycle. You run up your credit cards, then you get the subprime loan, pay them off, and then you got the credit companies don't realize you got the subprime loan, and they let you run up your credit cards again.
Yes.
So a lot of this is being concentrated then in the subprime lenders.
That's where we're seeing the majority of it. And what's interesting is when we're talking about subprime, we're not necessarily talking about low-income borrowers. We're talking about people everybody who is just stretched and taking out loans to cover up to cover their credit card debt. And what's interesting is the rates there are not that much lower than the credit card rates that they're paying. You know, even though the average personal loan rate is 12%, if you're talking about a subprime borrower, they're probably paying more like 28, above 20% for sure for a personal loan.
They're only
28% on a credit card.
The challenge facing America isn't eliminating debt. Debt itself isn't inherently bad. Businesses use debt. Governments use debt. Homeowners use debt. The real challenge is balance. Too little borrowing can slow economic growth. Too much borrowing can create instability. Finding the right balance is difficult because debt fuels spending, and spending fuels economic activity. That's why the debt conversation is so important. It's not just about personal finance. It's about how modern economies function. And whether long-term growth can continue relying on ever-increasing borrowing, fortunately, understanding debt changes how people interact with money. The goal isn't avoiding debt completely. The goal is understanding its purpose. Productive debt can help build wealth. Consumer debt can delay it. People who achieve long-term financial stability often focus on three things: controlling expenses, building savings, and understanding how interest works. Because once debt begins controlling financial decisions, freedom becomes harder to achieve. And that's the lesson many people wish they had learned much earlier.
These are lenders that, the majority of lenders are fintech lenders that are doing these personal loans. And it makes it very easy for people to sign up with one of these online banks, do the loan.
You sound like you're describing something that could end up badly like it did last time.
I think people need to understand that there is free help available with nonprofit credit counseling agencies. There are debt management programs available that can help people figure out how to get out of this cycle and not focus on so much making sure that they have a personal loan that's going to pay off everything, but understanding that you can't use the credit card if you're trying to pay off that debt. So once you have that personal loan and you're paying off the credit card, you don't use that credit card anymore. That's the issue.
At first glance, America's debt story appears simple. People borrow money. Debt increases. The numbers grow. But the reality is far more complex. Record debt isn't the result of a single decision. It's a result of rising costs, changing incentives, economic structures, consumer behavior, and a financial system where borrowing has become deeply integrated into daily life. The question isn't whether debt exists. The question is whether people understand the role it plays in their lives. Because debt can be a tool, or it can become a trap. And understanding the difference may be one of the most important financial skills anyone can develop. If you enjoyed this breakdown, subscribe to Finance Decoded. Every week, we uncover the hidden stories behind money, banking, debt, investing, and the economic forces shaping everyday life. Because the biggest financial lessons rarely come from headlines. They come from understanding how the system actually works. And the more you understand that system today, the better prepared you'll be for tomorrow.